Imagine you've been saving money for 15 years. Every paycheck, you put a little aside. You skipped the vacations. You drove the older car. You made the responsible choice. By 2008, you had $50,000 in your savings account. You felt safe. You felt smart. Now, fast forward to today. That $50,000 is still sitting there. Same number. Same digits on the screen. But here's what the data shows. Your money can now buy approximately 25% less than it could in 2008. According to Bureau of Labor Statistics inflation data, you didn't spend it. You didn't lose it in a bad investment. You didn't gamble it away. So where did that purchasing power go? According to Federal Reserve data, it went disproportionately to asset holders. Between 2008 and 2022, the Federal Reserve created approximately $9 trillion through a process called quantitative easing. The stated goal was to stabilize the economy. But here's what the numbers show. The top 1% gained approximately $20 trillion in wealth during this period. The bottom 50% saw minimal gains, and savings accounts lost significant purchasing power. Coincidence? The data suggests otherwise. Today, we're going to examine the largest wealth redistribution in modern history. We're going to follow the documented money flows from the Fed's balance sheet expansion. And we're going to show you what publicly available data reveals about how savings have been affected. This isn't conspiracy. This is documented math from official sources. Let's begin. Before we dive in, an important note. Everything in this video comes from official government sources. The Federal Reserve's own balance sheet data, the Congressional Budget Office, the Bureau of Labor Statistics. We're presenting their published numbers and documented analysis. This is educational content designed to help you understand monetary policy, not financial advice. Different economists interpret this data differently. We encourage you to review the primary sources yourself and consult qualified financial professionals for personal decisions. That said, understanding how this system works may be the first step to making more informed choices. Over the next 24 minutes, we'll cover 7 areas. How the Fed actually creates money, where that money tends to flow, a centuries-old economic principle about money distribution, the documented impact on purchasing power, who the data shows benefited most, why reversing course has proven difficult, and what this might mean for your planning. Let's start with the mechanism itself. Most people think the Fed prints money. That's not quite accurate. What they actually do is more sophisticated. Here's how quantitative easing works. The Federal Reserve doesn't print physical cash for QE. Instead, they purchase assets, treasury bonds, mortgage-backed securities, from banks and financial institutions. How do they pay for these assets? They credit the seller's reserve account with newly created money. It's an electronic transfer. A balance sheet entry. According to the Federal Reserve's H4.1 statistical release, their balance sheet expanded from approximately $900 billion in 2008 to $8.9 trillion at its peak in April 2022. That's roughly a 10x expansion in 14 years. To put that in perspective, from 1913 to 2008, 95 years, the Fed accumulated about $900 billion in assets. From 2008 to 2022, 14 years, they added approximately $8 trillion more. The balance sheet expansion of those 14 years exceeded the previous century combined. The Congressional Budget Office's report, CBO 57519, published September 2022, documents exactly how this happened. QE1. From 2008 to 2010. Approximately $1.7 trillion. Described as an emergency response to the financial crisis. QE2. from 2010 to 2011. Approximately $600 billion. Additional stimulus measures. QE3. From 2012 to 2014. Approximately $1.6 trillion. An open-ended program. And during the COVID-19 pandemic. QO4. From 2020 to 2022. Approximately $4.8 trillion. Emergency measures to stabilize markets. Here's one way to think about this. When the Fed expands its balance sheet, it's creating new money that enters the financial system. This money doesn't appear equally in everyone's pocket. It flows through specific channels. The question economic researchers have studied. When the Fed creates trillions of dollars, how does it flow through the economy? If you divided $9 trillion equally among all Americans, each person would receive about $27,000. That's not how QE works. When the Fed purchases bonds from banks, those institutions receive reserves. Banks typically seek returns on those reserves. So they invest in stocks, real estate, corporate bonds. When trillions of dollars flow into asset markets, economic theory predicts prices will rise. And the data appears to confirm this. The S&P 500 rose from 676 in March 2009 to over 4,800 in 2021. That's approximately a 600% increase. Home prices increased roughly 40% since 2020 alone, according to the Federal Housing Finance Agency. But here's the important context. Not everyone owns stocks. Not everyone owns real estate. According to the Federal Reserve's Survey of Consumer Finances, the top 10% of Americans own approximately 90% of the stock market. So when policies that inflate stock prices take effect, the data suggests approximately 90% of those gains flow to about 10% of the population. Let me illustrate with a hypothetical example. Consider someone we'll call Sarah. She's 42 years old, middle class, works hard, saves responsibly. In 2008, Sarah had $50,000 in her savings account, earning about 0.5% interest, roughly $250 a year. Her neighbor had $50,000 invested in a stock index fund. Fast forward 15 years. Sarah's savings account holds about $54,000. After compound interest, her neighbor's stock portfolio, potentially over $200,000, based on market performance. Sarah did nothing wrong. She was being responsible by saving. But the economic environment changed significantly, and the benefits of that change flowed primarily to asset owners. This phenomenon isn't random. There's actually a centuries-old economic principle that helps explain why this happens. In the 1730s, a French-Irish economist named Richard Cantillon made an observation about money creation. He studied what happened in 18th-century economies when new money entered circulation. His observation: the people who received new money first could spend it before prices adjusted upward. By the time that money circulated to workers and merchants, prices had already risen. The first receivers gained purchasing power. The last receivers faced higher prices. Cantillon died in 1734. But his observation, now called the Cantillon Effect, has been studied by economists ever since. Here's how some researchers apply this principle to modern monetary policy. When the Fed creates reserves, financial institutions receive them first. They can invest before the broader effects on prices occur. By the time those monetary effects work through the economy, through lending, through wages, through consumer spending, prices for goods and assets may have already adjusted. Those who received the money later face a changed price environment. One analogy: it's somewhat like a game where some players get to make their moves before the rules fully take effect. The Bank for International Settlements, often called the Central Bank of Central Banks, has published research examining similar distributional effects. Their analysis suggests monetary expansion can benefit asset holders relative to wage earners. This isn't fringe economics. It's a documented phenomenon studied by mainstream institutions. And many researchers argue it has been particularly relevant since 2008. So with that framework, let's examine what the data shows about purchasing power over this period. Let's look at some documented numbers. According to the Bureau of Labor Statistics Consumer Price Index, the dollar has lost approximately 25% of its purchasing power since 2008. In practical terms, if you saved $100 in 2008, it now purchases roughly what $75 would have bought then. This purchasing power decline occurred through inflation, rising prices across the economy. What contributed to that inflation? Multiple factors. Certainly. But many economists point to monetary expansion as one significant driver. Back to our hypothetical Sarah. Her $50,000 saved in 2008 can now purchase approximately what $37,500 could have bought then. That's a significant reduction in purchasing power. Roughly $12,500 worth, without spending a dollar. Meanwhile, asset prices rose substantially. Those gains accrued primarily to asset owners. Now, some might point out, but savings accounts earn interest. Let's examine the math. The average savings account rate from 2008 to 2022 was approximately 0.5% per year. According to FDIC data, inflation averaged approximately 2.5% per year during the same period. That's a negative real return of roughly 2% annually. For 14 years, savers were losing purchasing power despite earning interest. To be clear, inflation has complex causes. We're not claiming the Fed deliberately targeted savers, but the documented outcome of the policies implemented was asset prices rose significantly, purchasing power of cash declined, and the benefits flowed primarily to those who owned assets. These are the numbers from official sources. So if savers saw reduced purchasing power, who gained? Let's examine the wealth data. Between 2008 and 2022, the total wealth of American households increased by approximately $40 trillion. According to the Federal Reserve's Flow of Funds report zone. That sounds positive. But the distribution of those gains tells a different story. The top 1% captured approximately $20 trillion of that increase. Roughly half of all wealth gains went to 1% of the population. The top 10% captured approximately $36 trillion. That's about 90% of the gains flowing to 10% of people. The bottom 50%, their share of total wealth remained approximately 2%. 2% of total wealth, for half of all Americans. To illustrate concretely, as purchasing power declined for savers, asset values rose for owners. This wasn't necessarily intentional wealth extraction, but it was the documented outcome. And the Federal Reserve has access to this data. Their own survey of consumer finances shows stock ownership concentration. Their own economists have published research on QE's distributional effects. The data is public. The patterns are documented. Now, you might wonder, if these effects are known, why continue? That brings us to what some economists call the policy trap. The Federal Reserve faces a significant challenge. The policies that expanded the balance sheet are difficult to reverse. In 2018, the Fed attempted to shrink its balance sheet through quantitative tightening. The result? Significant market volatility. The stock market declined approximately 20% over several months. Stress appeared in short-term lending markets. The Fed adjusted its approach. Reducing the balance sheet, even modestly, proved challenging. Here's part of the underlying dynamic. The U.S. government carries approximately $34 trillion in debt, according to Treasury Department data. At higher interest rates, the annual interest payments on that debt could exceed $1 trillion. If rates rise significantly, interest costs could consume an enormous portion of federal revenue. So policymakers face difficult trade-offs. Maintain accommodative policies with their distributional effects, or tighten significantly and risk financial instability. Japan offers one historical parallel. They've maintained very low interest rates for approximately 30 years. Their debt-to-GDP ratio exceeds 200%. Normalizing policy has remained elusive. Many economists see the U.S. in a similar situation, though the specifics differ. The point isn't to predict the future. It's to understand that reversing these policies involves real trade-offs and challenges. So, given this environment, what does the data suggest for individuals? This isn't financial advice. It's educational context. And understanding starts with the data. You now have information many people don't. How monetary expansion works. How it flows through the economy. What the historical data shows about its effects. What you do with that understanding is personal. Some observations from the data. Cash savings have historically lost purchasing power during periods of monetary expansion. Asset prices have historically risen during such periods. These patterns are documented, though past performance doesn't guarantee future results. These aren't recommendations. They're observations from publicly available data. Every individual's situation is different. Risk tolerance varies. Time horizons matter. Personal circumstances are unique. Qualified financial professionals can help translate general observations into personal strategies. What we can say is this: understanding how monetary policy works and who it historically benefits may help you make more informed decisions. Remember hypothetical Sarah. With better information earlier, she might have made different choices. Or not. Every situation is unique. The point isn't to tell you what to do. It's to ensure you have access to the same information that financial institutions do. What you do with it is your choice. Let's summarize what the data shows. The Federal Reserve expanded its balance sheet by approximately $9 trillion. The stated goal was economic stabilization. The documented effects include significant asset price appreciation, purchasing power decline for dollar-denominated savings, wealth gains concentrated among asset owners. These aren't accusations. They're numbers from official sources. The top 1% gained approximately $20 trillion in wealth. Savings accounts lost roughly 25% of their purchasing power. And reversing these policies has proven challenging. What does this mean for you? First, understanding. You now have context that many don't. Second, evaluation. Consider where your wealth is positioned. Third, informed decision-making. Work with qualified professionals on your specific situation. The economic environment has changed significantly since 2008. Understanding how may help you navigate what comes next. If this analysis was helpful, consider subscribing for more data-driven examinations of economic policy. For related context, check out our video on the national debt trajectory. This is the Economic Realist. Stay informed. Make data-driven decisions. See you in the next one.